Hey everyone, this is John Robinson. Today's February 28th, 2022, and this is a monthly asset allocation update video. In this month's video, we'll review, as usual, the asset allocation changes, and then a few key takeaways and talking points that are helpful for you and your clients as we head into March. In the longer form written piece, which is why we produce this video really as a supplement to that piece, we talk a lot about adaptability and how when designing strategies, it's better to acknowledge upfront that you don't know the future and to design your strategies really taking as little from the past as possible. And one of the phrases we like to use is that we design strategies to fit markets more like a mitten than a glove. And we feel this is the best way to operate in an unknowable, uncertain environment, especially in the context of an advisory business where you're focused on client goals and client behavior. So if you haven't checked that out, I would encourage you to do so and give us feedback on it. When you look at asset allocation changes for blueprint portfolios heading into March, really there's very little changes. We made a fairly large material shift down in equity exposure, U.S. equity exposure in particular, coming into February, which certainly helped us. It allowed us to, at least to this point, outperform a lot of the passive benchmarks that we might comp to, simply because we reduced equity risk and they didn't. So on an absolute return basis and a volatility basis, we've benefited from those reductions this month. No change to U.S. equities as we head into March because the long-term trend is still intact while the intermediate-term trend is still down. Foreign and emerging market equities, while they've been relative outperformers in 22 thus far, they're still in downtrends over both timeframes, so no change there. Real estate, no exposure change. The intermediate-term trend is down, which we saw at the end of January and made a risk adjustment there downward. But the long-term trend is still intact. U.S. and international treasuries are the same way, really, across the yield curve. There's no change. We see downtrends, and the short end of the curve remains the strongest portion of the yield curve. Inflation-protected bonds are the same way, really across the entire fixed income complex. We're seeing downtrends. Short-term fixed income will decrease slightly, and that's simply a result of the emergence of a rising long-term trend in gold. Gold received, or the proceeds from the past sale of gold went to short-term fixed income, and now because of our handoff process, we'll just simply hand that back to gold now that it's in a long-term uptrend. How that looks on a graph, you'll see here not many changes, except we're taking from U.S. Treasuries, ultra short-term U.S. Treasuries, and simply handing that to our alternatives portfolio, which is comprised of gold at the moment. So what are the key takeaways? Well, first, the decline in U.S. equities continues. This is the worst drawdown that we've had since the Corona crash. If you look at from the absolute high to the absolute low, at least as we know it right now, we're looking at about a 15% drawdown in the S&P. Now, that's nowhere near what we saw in the Corona crash of just over 35% peak to trough or high to low. But this is the most significant drop we've had in stocks since then. Blueprint portfolios are fairly boring. We have reduced risk. We're in a defensive posture right now, not the most defensive we can get because the long-term trend in U.S. equities is still up. But because of the intermediate-term downtrend in U.S. equities, we remain defensively postured, with the only changes going into March being a reduction in ultra short-term fixed income in favor of gold due to its long-term uptrend. And lastly here, the adaptability is key for us. Adaptability ensures survival. And when you're in this market, survival becomes paramount. No one really talks about surviving large drawdowns or bear markets in years like 2021 or 2019 or 2017 because there's no down volatility. And everyone's time frames are what they want them to be. But it seems that with the increase in volatility, time frames become compressed. And clients go from looking at the markets maybe on a quarterly basis as they're looking at their statements to looking at them multiple times a day. And so this is when biases show up. And for us, being adaptable means designing a process that's not overly fit to any one market environment, but one that we feel like will fit future environments approximately. And really that's based on human nature. That human nature is the one consistent item that or variable that we can count on going forward. And so that's why we use trends. And when we develop our intermediate term or long-term systems, and even potentially more going into the future, what we really want to do is not take too much from the past in that we develop these rules and the parameters around those to fit exactly past market events, because we know that won't work in the future. And when you think about what's going on right now in the context of Russia and interest rates, inflation, there's no way to predict that these things will hit all at once. I think it's fair to say that we can predict that at some point in the future, one of these three variables or items will be is a risk that we need to account for. But the complexity involved in the world makes it impossible to predict all of those three things happening at one time. And yet, our models are reacting. Our models reacted last month in advance of the downfall in February. And should this move continue and the long-term trend engages to the downside for U.S. equities, we'll simply continue to reduce risk and get even more defensive. And why do we do that? Well, we do that to protect compounding. We want to help you meet your clients' goals. And we want to shrink the variability around that expected return as much as we can, and avoiding large losses is the best way for us to do that. Now, in a period like this, where volatility is high, you may be getting an increase in client phone calls or client communications coming to you. And you may want to reciprocate by sending out a marketing piece, a content piece, or simply getting on a phone call with you and your clients to answer questions. So I would just ask, what can we do for you to help you communicate to your clients, make them feel more comfortable, and ultimately keep them in their seats to achieve their long-term goals? And nothing's off the table. So we just ask you to reach out to advisors now, and it seems to be helping them, certainly in their practice, and their clients by extension. So if you want to reach out to us, go to our website, blueprintip.com. You can reach out to me. My email's on the screen and my phone number's on the screen. So with that, thanks for your time. Thanks for your attention. And we look forward to seeing you again here at the end of March. Thanks.